credit spread is similar to the way a bank has a profitable spread on their interest. So they pay their depositors interest and they earn interest off the loans that they give out. So they're making a net profit in the spread. And as yourself, if you happen to have cash and are in college, those are the two things you would need. You're wide open to all of these college loans, and they all have subsidized rates that are fairly good, and they pretty much will give you as much money as you want, it seems. And if you have cash, you could invest it and you have this regular return that you can calculate. So you have your investment return and you have this college interest cost, and the spread usually will leave you with a profitable margin there. So rather than use your cash to pay for school, which so many people do, you should instead leverage up on the student loans that are subsidized and invest it, and then monitor your yield. And if it is more than your college interest, then that's free money. If you happen to have a really good quarter because you've opened yourself up to the upside potential of your investments, if you have a good quarter, you just made a lot of profit. If you have a bad quarter, you simply use your investments to pay your student debt off. So you could very easily break even. You're opening yourself up to upside potential. So that's a chance I'm willing to take. Given a consistent return and some pretty smart investing and some pretty solid strategies, your break-even point is well within your grasp. And so if you're making 9% on your investments and you're paying 7% in college interest, that's only a 2% profit margin. You may think that's not worth it, but that is free money, so I would take the free money. So this would be the balance of the loan. This was the interest that my investments are returning. This is the interest I'm paying on the loan. This would be, the total interest, total balance, total gain, total realized gain right here. So as the loan would grow in size, my yield on my investment is actually increasing because I'm measuring it against my loan balance. Because when I pay down my loan balance, this will start shrinking. And my interest payment kicks in here. So we've already made $5,000 of interest off of our investment by having subsidized interest payments. I've made $5,000 of yield. So now I start paying, it starts at $250 and starts diminishing as I'm paying it off, the interest per month on $40,000. But I'm making $400 a month on $40,000. So, and this is a real return. So I'm definitely, it's getting closer. It was 11, it was 14 up here. Those are good market periods. It's definitely cooled now where I'm at 0.08, but it's still making a profit of $100 per month. And I'm up to $7,600 of realized gain and actual profit than if I had just used the same amount of capital to pay off school as I went to school. So instead, I kept the capital in the investments and I took on debt to pay for school and end up with a $7,000 profit. I don't know if there's any complicated formulas here. It looks like they're all pretty self-explanatory. It's more about recording the data, having that data available, having a consistent return, having my strategies in place, and knowing with confidence that they're going to keep working into the future.